Welcome back to the Daily Crypto Deep Dive. If you're listening right now, take a second to follow the show and drop a 5-star rating. It keeps independent crypto storytelling alive and helps more people find this channel. Today, we're going back in time, back to the early days when Bitcoin was a joke on obscure forums, when nobody could have imagined that something worth less than $1 would one day change the financial world forever. This is the story of the $1 Bitcoin that could have been. The lost coins, forgotten hard drives, vanished passwords, and human errors that still shape Bitcoin's supply, price, and mythology. Every digital movement leaves a footprint on the blockchain, but millions of Bitcoin, an estimated 3 to 4 million, according to Chainalysis, will never move again. They sit in abandoned wallets, frozen like fossils in the digital rock. Some were mined on laptops in 2009 and 2010 by curious programmers who just wanted to see if it worked. Others were bought for pennies, stored on USB drives, or scribbled on scraps of paper. And then there are the tragic ones. Fortunes locked away behind lost passwords, destroyed devices, and forgotten seed phrases. When Bitcoin's total supply is capped at 21 million, losing 3 or 4 million isn't just a story. It's an economic event. It makes Bitcoin scarcer than anyone planned. It rewrites the math behind supply and demand. Let's start with one of the most famous names in crypto folklore. James Howells, the Welsh IT engineer who mined around 7,500 Bitcoin in the early days and accidentally threw his hard drive into a landfill in Newport. At today's prices, that drive would be worth hundreds of millions of dollars, buried under tons of rubbish. He spent years trying to persuade local councils to let him excavate the site. He's even offered to fund robotic recovery missions with AI scanners and environmental guarantees, but the bureaucracy never budges. Imagine knowing your life's fortune sits under a pile of old coffee cups and dirt, and you can't touch it. Then there's Stefan Thomas, the San Francisco developer who earned 7,002 Bitcoin for making an explainer video back in 2011. He stored his coins on an IronKey, a secure USB device that allows only 10 password attempts before it permanently locks. He's tried 8 times. 2 guesses remain between him and over $200 million. In interviews, Thomas says he keeps the IronKey sealed away, waiting for new recovery technology. But emotionally, he's moved on. He focuses on the lesson it taught him about security and humility. Stories like these have become legend, but they're not rare. Across forums and subreddits, you'll find tales of early miners who left laptops running overnight and forgot about them. Students who formatted old computers. People who sold hard drives on eBay without realizing what sat on them. Each one adds another ghost wallet to Bitcoin's invisible supply. Analysts estimate that between 17% and 20% of all mined Bitcoin is lost forever. Glassnode calls these unspent transaction outputs, coins that haven't moved in over a decade and are statistically dead. That means the effective supply of Bitcoin isn't 21 million. It's closer to 17 million, maybe less. That hidden scarcity affects price models, especially those like Plan B's stock to flow, which assumes full circulation. In practice, Bitcoin's real stock to flow is tighter than gold's because so many coins are gone. In other words, human forgetfulness is now part of Bitcoin's value proposition. It's ironic. The same decentralization that makes Bitcoin powerful also makes it unforgiving. There's no help desk, no password reset, no forgot your key button. Your coins live and die with your ability to control them. And that's part of why people trust the system. It's final, immutable, brutal, but fair. Every so often, though, the blockchain gives us a scare. A zombie wallet awakens. An address that's been silent for 10 years suddenly sends a transaction. Traders panic. Was it Satoshi Nakamoto? Was it an early miner cashing out? Or just someone who finally found their old keys? These rare moments can swing market sentiment instantly. When one of Satoshi's early blocks moved in 2020, Bitcoin dropped 5% in an hour. The fear wasn't rational, it was symbolic. Behind the mystery, there's math. Analysts at Coinmetrics have spent years building heuristics to identify which wallets are probably lost. They track patterns like dust transactions, dormant periods, and lack of activity across forks. Their conclusion: somewhere between 3 and 3.8 million Bitcoin are permanently gone. At current prices, that's roughly $340 billion in lost value. And it's not just Bitcoin. Ethereum, Dogecoin, and Solana all have their share of lost tokens. But Bitcoin's is unique because its fixed supply turns every lost coin into permanent deflation. The less remains, the more each surviving Satoshi matters. For investors, that lost supply adds subtle upward pressure. Fewer coins in circulation mean long-term holders control more of the effective market. It's part of why Bitcoin has been able to absorb massive shocks, from exchange hacks to regulatory scares, and still climb higher in every major cycle. Scarcity works even when it's unintentional. Still, the human side of this story is what makes it unforgettable. Imagine logging into an old email account, seeing an exchange registration from 2011, and realizing you once owned 100 Bitcoin you sold for rent. People share those moments on social media every bull run. Screenshots of emails from Mt. Gox, Coinapult, or early Coinbase receipts. Each one a reminder that the past can haunt you in decimal form. And for those who've lost access completely, there's an industry built around hope. Companies like Wallet Recovery Services and KeychainX specialize in helping people brute force their old wallets. They take a cut of any recovered funds, sometimes up to 20%. But for many, that's a small price for a second chance. Some even use AI to guess forgotten passphrases, analyzing typing habits and old notes. But as one recovery expert told Bloomberg last year, most of what's lost stays lost. People overestimate how random their passwords were. The truth is, for every miraculous recovery, hundreds of wallets remain unreachable. It's digital archaeology. Occasionally you find treasure, but mostly you find dust. What's fascinating is how these lost coins shape not just Bitcoin's supply, but its mythology. They remind us that this isn't just software, it's a mirror of human behavior. Greed, forgetfulness, luck, tragedy, all encoded in the blockchain. One early developer once said, "Bitcoin isn't backed by gold, it's backed by lost passwords." And he wasn't wrong. Because every mistake creates scarcity. Every deleted wallet makes the remaining coins more precious. It's poetic, value emerging from human imperfection. And this ties directly into why long-term investors treat Bitcoin differently. They understand that holding Bitcoin isn't just about buying, it's about securing. It's about being your own bank. And with that comes responsibility. Self-custody is both power and burden. Lose your key. Lose your wealth. Protect it, and no government, hacker, or bank can take it from you. That's why hardware wallets like Ledger exist, to make self-custody safer without the risk of human error. If you've ever thought, "I'll write my seed phrase down later," or "I'll back it up next week," let these lost fortunes remind you, the time to secure your assets is now. You can find the Ledger link in our show notes. Use it before you need it. But beyond caution, this story also reveals Bitcoin's deeper philosophy. Ownership through accountability. When you hold your keys, you hold a piece of that early chaos. The proof that digital scarcity isn't theoretical, it's real, measurable, and human. And maybe that's what Satoshi intended all along, a currency that teaches through consequence. Every time we talk about lost Bitcoin, someone asks the same question. What if they're not really lost? What if one day those coins move again? It's a haunting thought, because the answer could reshape everything from Bitcoin's price structure to its trust narrative. Let's look at the numbers. Around 19.7 million Bitcoin have been mined so far. Out of that, analysts at Glassnode estimate that only about 12 to 13 million are actively circulating. The rest are dormant, some lost, some held by long-term investors who simply never move them. In other words, over a third of Bitcoin's supply has effectively disappeared from daily use. Now imagine if even a fraction of that came back online. If 500,000 lost coins were suddenly recovered and sent to exchanges, it would be like opening the floodgates of liquidity. Bitcoin's price could drop overnight. Not because people are selling, but because the psychological safety net of scarcity would vanish. That's why every time an ancient wallet stirs, the market reacts with panic. But in truth, the odds of mass recovery are almost zero. Private keys aren't just misplaced, they're mathematically sealed. Without them, the blockchain doesn't care who you are, what you owned, or how rich you once were. It's like a vault with no door. And that's what gives Bitcoin its power. It's unbreakable by design. One analyst at Ark Invest recently described these lost wallets as proof of incorruptibility. In her words, the finality of Bitcoin isn't only about transactions, it's about consequences. Those lost coins are the price of independence. It's a perspective worth sitting with. In traditional finance, you can call your bank, verify your ID, and restore access to your account. In crypto, you are the bank. If you forget the combination, nobody else can save you. That's terrifying, but also what makes the system bulletproof. That's why lost Bitcoin doesn't weaken the network. It strengthens it. It demonstrates that even catastrophic human error can't bend the rules. No politician, hacker, or billionaire can rewrite a single lost transaction. They're gone forever, and in that permanence lies faith. But this permanence also distorts Bitcoin's macroeconomics in ways we're only beginning to understand. When Satoshi Nakamoto created the 21 million cap, he didn't expect so many coins to vanish. Every 4 years, the halving event cuts new supply in half, pushing scarcity higher. But if we're already down several million coins, each halving becomes even more impactful. To put it into context, after the 2024 halving, the block reward dropped to 3.125 Bitcoin. That means just over 164,000 Bitcoin will be mined this year, a small trickle compared to what's already lost. If 3 million are gone forever, then by the late 2030s, nearly 20% of all effective Bitcoin supply will be post-halving output. Analysts at Fidelity Digital Assets recently published a paper on this, calling it the phantom deflation effect. They estimated that if the current rate of lost coins continues, Bitcoin's real inflation rate after the next 2 halvings could fall below 0.1%, effectively making it harder than gold. That's not just poetic, it has market implications. Ultra-low supply growth can create price floors, because even modest demand outpaces available liquidity. That's why long-term holders, the HO dealers, are often the calmest voices during crashes. They understand the math. They know there's less Bitcoin out there than anyone can prove. But beyond math, there's psychology. The stories of loss anchor Bitcoin's mythos. They make it feel real. When people hear about someone losing 10,000 BTC buying 2 pizzas, it humanizes the technology. It reminds them that behind every wallet address is a person with fallible memory, human habits, and moments of carelessness. And ironically, that humanity is what draws people in. Bitcoin isn't just code, it's history. Every block contains human fingerprints, experiments, mistakes, triumphs, disasters. When you think about it, the blockchain is a museum of human ambition, and some of the most valuable artifacts are the ones nobody can touch. Take a look at this address. It's one of the most famous frozen wallets in existence. It holds 79,957 BTC, worth around $9 billion, believed to be stolen during the early Mt. Gox era. The coins have never moved. They sit there, taunting anyone who opens a block explorer. They're technically active, but effectively lost forever, because moving them would instantly reveal the thief. This is part of Bitcoin's strange duality, visibility without access. Everyone can see the treasure, but no one can claim it. It's a digital monument to the concept of look, but don't touch. That same transparency has also created a new field of on-chain forensics. Firms like Chainalysis and Nansen track wallet movements, flag stolen funds, and analyze lost supply. It's a kind of blockchain archaeology. Data scientists digging through layers of transaction history instead of sand and soil. Chainalysis even classifies certain ancient wallets as Satoshi candidates, dormant addresses from 2009 and 2010 that mined in the same pattern as the creator. Every so often, speculation flares up when one of those addresses moves. But Satoshi's original stash, around 1.1 million BTC, has never been touched. If those coins truly are lost, then Bitcoin's real supply is even smaller than we think. And that has profound implications. If the creator's coins never move, Bitcoin's founder has effectively removed himself from the economy, ensuring no single entity can crash the market. It's a kind of self-sacrifice that fits the mythology perfectly. The invisible architect who built something immortal and then vanished. For investors, though, all this history circles back to one practical lesson. Secure your holdings. Every lost wallet, every ghost address, every landfill drive, they all point to one thing. Custody matters. Because what makes crypto powerful isn't that it's unhackable. It's that you hold the keys to your own future. But that also means you are the weak link. And that's where hardware wallets, redundant backups, and cold storage become essential. Even small investors, the ones with a few $100s in Bitcoin, need to think like institutions. Because in this system, mistakes don't get forgiven. It's why I keep repeating this every episode. If you don't hold your keys, you don't hold your crypto. Protect your stack with cold storage. I've linked Ledger in the description. It's one of the few things between you and becoming part of the lost coin statistics. Now, let's zoom out. What do these lost fortunes mean for Bitcoin's next chapter? As adoption spreads and institutional players like BlackRock, Fidelity, and JP Morgan bring billions into the space, the supply crunch will only intensify. ETFs are vacuuming up Bitcoin faster than miners can produce it. Combine that with millions of coins gone forever, and you have a setup that analysts at Bernstein recently called a structural bull trap for the dollar. Their point was simple. Demand is compounding, supply is static, and lost coins amplify both effects. In other words, those early mistakes are now the market's foundation. The landfill in Wales, the IronKey in California, the pizza from Florida, each one reduced available supply, and by extension, increased the resilience of what's left. You could even argue that Bitcoin's most bullish feature isn't its code, but its history of loss. Every vanished coin makes the survivors rarer. Every forgotten wallet adds weight to the ones still active. It's as if the market keeps pruning itself, evolution by human error. And as strange as it sounds, that may be why Bitcoin has endured. Other assets inflate, currencies get printed, stocks dilute. But Bitcoin burns through time, hardened by every mistake ever made with it. One trader on X summed it up perfectly last week. Bitcoin is the only asset where human stupidity makes everyone else richer. He meant it as a joke, but he wasn't wrong. So, as you close this episode and maybe check your own wallets, remember this. Every story of loss is also a reminder of why the system works. Bitcoin is scarce not just by design, but by destiny. And if you think about it, maybe that's what Satoshi wanted all along. Because in a world where every mistake has value, every forgotten coin tells the same story. That even in digital form, money is still human. Follow the show for tomorrow's breakdown. And as always, drop that 5-star rating if you learned something today. It keeps the signal strong, the lights on, and the conversation alive. We'll be back tomorrow. This has been your daily crypto deep dive. And as always, we'll see you at the top.